The US dollar showcased remarkable resilience and strength throughout the week, solidifying its position as a dominant force in the forex market. A key driver of this upward momentum was the release of robust labor market data, which exceeded market expectations and reaffirmed the strength of the US economy. Non-farm payroll figures revealed higher than anticipated job creation, signaling that the labor market remained resilient despite broader economic uncertainties. This data amplified investor confidence in the US dollar, as a strong labor market is often viewed as a precursor to sustained economic growth. Adding to the dollar's upward trajectory were rising US Treasury bond yields, which surged in response to the labor market data and persistent inflationary pressures. Higher yields made US assets more attractive to investors, increasing demand for the greenback. Moreover, markets began pricing in the possibility of the Federal Reserve maintaining elevated interest rates for a longer period, given inflation's resilience and the economy's robust performance. These expectations were further fueled by recent comments from Federal Reserve officials, who emphasized their commitment to combating inflation. On a broader scale, geopolitical uncertainties and concerns about slower economic growth in other major economies, such as the Eurozone and China, created a flight to safety. The US dollar, being a global reserve currency, benefited significantly from this risk-off sentiment. The dollar index, DXY, surged past the critical 109.50 resistance level, a psychological threshold that reinforced the bullish outlook for the greenback. This upward momentum underscored the dollar's attractiveness as a safe haven asset amid global economic turbulence. US dollar, USD, detailed brief. The US dollar exhibited notable strength during the week of January 13 to 17, 2025, driven by favorable economic indicators and market dynamics. Robust labor market data. Non-farm payrolls, the US economy added 265,000 jobs in December, surpassing market expectations of around 200,000. This strong performance reaffirmed the resilience of the US labor market. Unemployment rate. The unemployment rate remained steady at 3.5%, a multi-decade low, indicating sustained strength in the job market. Rising bond yields. U.S. Treasury yields climbed as investors anticipated further rate hikes from the Federal Reserve. The 10-year Treasury yield approached 4.5%, attracting foreign capital and boosting the dollar's appeal. The higher yields underscored the market's belief that the Fed may maintain its hawkish stance to tackle inflation. Dollar Index, DXY, performance. The DXY, which measures the dollar against a basket of major currencies, surged past the critical 109.50 resistance level, signaling a bullish breakout. The index's rise reflects a combination of dollar strength and relative weakness in other currencies, particularly the euro and the yen. Inflation expectations. Persistent inflation concerns added to the dollar's momentum. With the Consumer Price Index, CPI, showing a month-over-month increase of 0.4%, annualized at 3.7%, markets anticipated that the Federal Reserve might delay pivoting to a dovish stance. Political and fiscal influences. Under the new administration, expectations of increased fiscal stimulus and infrastructure spending contributed to speculation about higher inflation and stronger economic growth, further supporting the dollar. Market sentiment. Risk aversion in global markets also played a role. Concerns about global economic slowdowns, particularly in Europe and China, drove investors to seek safety in the dollar as a haven currency. The US dollar's rally during the week was supported by a mix of positive economic data, rising bond yields, and investor expectations of continued Federal Reserve action. The currency's strength against major peers reaffirmed its status as a global safe haven asset. Overall, the convergence of strong domestic data, higher yields, and global risk aversion positioned the US dollar as a standout performer in the forex market, driving its gains against major currencies and reinforcing its dominance during the week. The euro experienced significant weakness against the US dollar over the past week, with the euro to US dollar pair slipping below the critical 1.0200 level, marking a new multi-year low. This downward trend was driven by a combination of factors, both external and internal, that painted a bearish picture for the euro. A primary driver was the ongoing strength of the US dollar, buoyed by robust labor market data, rising bond yields, and expectations of prolonged Federal Reserve policy tightening. The dollar's ascent applied consistent pressure on the euro, which struggled to maintain support levels amidst intensifying bearish sentiment. Weak economic data from the eurozone further compounded the euro's challenges. The region reported lower-than-expected industrial production figures, alongside a slowdown in services and manufacturing activity as reflected in Purchasing Managers' Index (PMI) surveys. These indicators signaled that economic momentum in the eurozone was faltering, stoking concerns about the possibility of a protracted economic slowdown or even recession in the region. The challenges were exacerbated by rising energy costs and inflationary pressures, which have burdened businesses and consumers alike, limiting economic recovery prospects. Adding to the euro's struggles were developments in China, one of the eurozone's major trading partners. Economic data out of China revealed weaker than anticipated growth and a sluggish recovery in key sectors, which dampened export prospects for the eurozone and weighed on market sentiment. Furthermore, the European Central Bank (ECB) maintained a cautious tone in its recent communications, highlighting the delicate balance it must strike between managing inflation and supporting growth. This dovish stance diminished the euro's appeal relative to the more aggressive tightening narrative coming from the Federal Reserve. Overall, the interplay between a resurgent US dollar, weak domestic economic performance, and external headwinds created a perfect storm for the euro, driving the euro to US dollar pair to fresh lows and reinforcing the bearish outlook for the currency in the near term. The British pound faced notable pressure throughout the week, declining against both the US dollar and the euro as disappointing domestic economic data undermined market confidence. A key factor driving the pound's weakness was the release of December's retail sales figures, which showed an unexpected contraction of 0.3% compared to market expectations of a 0.4% increase. This unexpected drop in consumer spending, traditionally a strong driver of the UK economy, especially during the holiday season, raised concerns about the health of the British economy. The weak retail sales figures suggested that households were continuing to feel the strain of high inflation and elevated borrowing costs, both of which have eroded disposable income. Consumer sentiment also remained fragile, reflecting broader uncertainties about the economic outlook. These developments added to a growing sense of unease that the UK economy might be entering a period of stagnation, or potentially even a mild recession, as domestic demand falters. The data further fueled speculation that the Bank of England, BoE, might pivot towards a more dovish monetary policy stance. With inflationary pressures showing signs of easing and growth risks intensifying, markets began to price in the possibility of additional interest rate cuts in the coming months. Such a move would likely diminish the yield advantage of the pound relative to other major currencies, reducing its attractiveness to investors. Externally, the pound also faced challenges from a strong US dollar, which continued to benefit from robust US economic data and rising Treasury yields. The divergence in economic performance and central bank policy between the US and the UK amplified downward pressure on the pound sterling to US dollar pair. Meanwhile, against the euro, the pound's decline reflected growing concerns about the relative vulnerability of the UK economy compared to its eurozone counterpart, even amidst shared challenges such as sluggish growth and inflation. Overall, the combination of weak economic data, rising fears of stagnation, and shifting monetary policy expectations created a challenging environment for the British pound, leading to its declines against major currencies during the week. The Indian rupee faced significant downward pressure last week, marking its worst performance in 18 months as it weakened by 0.6% to close at 86.61 per US dollar. This decline reflected a confluence of domestic and global factors that intensified selling pressure on the currency. A major driver of the rupee's weakness was sustained foreign portfolio outflows, as global investors continued to pull capital out of Indian equity and debt markets. This trend was fueled by a combination of risk-off sentiment in global markets, rising US Treasury yields, and a stronger US dollar, all of which diminished the appeal of emerging market assets. In the non-deliverable forwards (NDF) market, there was increased demand for the US dollar, further amplifying downward pressure on the rupee. The NDF market often acts as a barometer for offshore investor sentiment, and the rise in dollar bids highlighted growing concerns about the rupee's near-term prospects amid global economic uncertainties. Additionally, India's trade deficit remained elevated, putting further strain on the currency as importers increased their dollar purchases to meet payment obligations. The Reserve Bank of India, RBI, stepped in to stabilize the rupee, intervening by selling US dollars in both the spot and forwards markets. This intervention was aimed at preventing the rupee from breaching critical levels and reaching a new all-time low. While the RBI's actions provided temporary support, they also underscored the growing challenges of managing currency stability in the face of external pressures. Domestically, the rupee's depreciation has raised concerns about its impact on inflation and import costs, particularly for energy and other essential commodities. A weaker currency makes imports more expensive, which could exacerbate inflationary pressures and complicate the RBI's monetary policy decisions. On the global front, the rupee's struggles mirrored broader trends among emerging market currencies, many of which have come under pressure due to the Federal Reserve's tightening cycle and geopolitical uncertainties. Overall, the Indian rupee's performance during the week highlighted the vulnerabilities of emerging market currencies in a challenging global economic environment. The interplay of persistent foreign outflows, dollar strength, and domestic economic factors created significant headwinds, leaving the rupee at its weakest levels in over a year and a half. During the week, the Japanese yen experienced heightened volatility due to increasing speculation around potential policy adjustments by the Bank of Japan, BOJ. Market participants were closely scrutinizing the BOJ's upcoming decisions, driven by a mix of rising global bond yields and domestic economic signals. The yen, traditionally seen as a safe haven currency, has been caught in a tug-of-war between its inherent stability and the growing divergence in monetary policies between global central banks. As U.S. bond yields surged on the back of strong economic data and inflation concerns, the BOJ's ultra-loose monetary policy stance stood out, amplifying concerns about future moves. The BOJ has long maintained its yield curve control (YCC) policy, aiming to keep 10-year Japanese government bond yields around zero. However, with global yields climbing, some traders are speculating that the BOJ may need to adjust its stance to prevent significant market distortions or currency depreciation. The potential for a policy shift has sparked heightened volatility in yen pairs, with traders positioning for both the possibility of yield curve adjustments and the potential impact on currency values. Furthermore, Japan's domestic economy has faced challenges, with inflation exceeding the central bank's target but growth remaining tepid. This has put additional pressure on the BOJ to navigate a delicate balance between supporting economic recovery and managing inflation. The central bank's communication around these issues has been closely monitored, and any hints toward a potential shift in monetary policy have led to sharp moves in the yen. As a result, traders have been actively positioning themselves in yen pairs, driving swings in the currency throughout the week. The heightened uncertainty surrounding BOJ policy and its implications for currency markets has created a dynamic trading environment, with volatility expected to persist until more clarity emerges from the central bank's next steps. Gold prices saw a significant rally last week, surging above the crucial $2,675 resistance area, even in the face of a strong US dollar. This move was primarily driven by gold's role as an effective inflation hedge, as investors continued to seek safe haven assets amid rising inflation concerns and economic uncertainty. While the dollar strengthened due to robust U.S. economic data, including solid labor market figures and rising treasury yields, gold managed to hold its ground and even push higher, highlighting its unique position as a store of value during times of inflationary pressures. The persistent concerns around inflation, both in the U.S. and globally, have kept gold in demand. Central banks worldwide, including the Federal Reserve, have signaled that inflation is likely to remain elevated, prompting investors to turn to commodities like gold, which historically tend to perform well during periods of rising consumer prices. Gold is often viewed as a safe haven that retains value when currencies depreciate due to inflation, making it an attractive asset during periods of monetary uncertainty. Additionally, geopolitical tensions, such as ongoing conflicts and geopolitical risks, have further bolstered gold's demand as investors look to safeguard their wealth against potential global instability. The strength in gold was also supported by physical demand from major consuming countries like India and China, where seasonal factors and economic resilience have driven buying interest. Although the US dollar remained strong throughout the week, its impact on gold was somewhat muted as traders focused more on the precious metal's role as a hedge against inflation rather than its inverse relationship with the dollar. This divergence has allowed gold to outperform other currencies and commodities, with prices rallying to levels not seen since early 2022. Overall, the surge in gold prices above the $2,675 resistance zone reflects the ongoing demand for inflation protection, coupled with strong physical buying and geopolitical uncertainties, which continue to support the precious metals' upward momentum. In conclusion, the Forex market during January 13 to 17, 2025, was shaped by a mix of global economic data, monetary policy expectations, and geopolitical uncertainties. The US dollar emerged as a standout performer, driven by robust labor market data, rising bond yields, and a strong safe haven appeal amid global volatility. Conversely, the euro, pound, and Indian rupee faced significant challenges, weighed down by weak economic data, foreign portfolio outflows, and pressure from a strengthening dollar. The Japanese yen experienced heightened volatility due to increased speculation around potential policy shifts from the Bank of Japan, while gold continued to surge, driven by persistent inflation concerns and demand for safe haven assets. Overall, these movements highlight the ongoing influence of macroeconomic factors on currency pairs and commodities, setting the stage for continued volatility in the forex markets. As traders and investors navigate these complex dynamics, staying informed and prepared will be crucial in making informed trading decisions. Whether it's through analyzing economic data, central bank policies, or market sentiment, understanding the driving forces behind these movements can help traders position themselves effectively in the ever-changing forex landscape. Thank you for watching. Make sure to like, subscribe, and hit the notification bell to stay updated with the latest forex insights and trading strategies. Stay tuned for more updates next week, and happy trading. Globe with meridians chart increasing with yen.